Hello, today I'll be discussing types of ownership. To understand types of ownership, you need to understand entrepreneurship, which is the practice of starting a business or enterprise with the goal of making a profit. When a business is created, there are multiple forms of ownership, and each form of ownership has its own advantages and disadvantages. Looking at a societal level, types of ownership are so important because they determine how your business is organized, how the money flows in and out of your business, and how your business will be taxed, both on a business scale and on an individual scale. One type of ownership is sole proprietorship, which is an unincorporated business that is owned by one individual. To summarize, the advantages of sole proprietorships is that they are easy, you have all the control, simple as there is less regulated, and there is no business taxes. There are only taxes based on the personal rate of the owner. But in the disadvantages side, it's very risky as all risk and liabilities are assumed by the owner. Commitment, you have to put in all of your time and skills to make the business work. If you don't have the skills, the business will fail. Conflict, if the owner dies, the business will dissolve because it is not a separate entity from the person. And finally, capital. It's difficult to raise capital for sole proprietorships because you have no way of selling shares in your company like you do with a corporation. Another form of ownership is partnership, a business where two or more owners parties manage a business and share its profits. Some advantages of partnerships is that there's a collaborative nature, meaning that partners get to contribute their thoughts, skills, and network to the business, which can help make it more efficient. Unlike corporations, it's still quite simple as there's less compliance requirements and regulations. Easy. It is not hard to actually form a partnership, as the only thing you need is a partner agreement. And then finally, it is fluid, as you can easily make decisions as there's not a bunch of people in the company that you have to deal with. But on the disadvantages side, there's mutual agency where you are liable for your other partner. So if they make a bad decision, it can impact you. Time, many times partnerships will eventually fall apart. And in terms of liability, you still have the potential for unlimited liability, not limited liability, meaning that you are still liable for the risks of the company. And then finally, conflict. If you have bad partners, this can actually lead to reduced efficiency. The final type of ownership is corporation. While there are different forms, we will just be summarizing as a whole, and it is an incorporated business recognized by the states as a legal entity separate from its owners. Some advantages of corporations is limited liability, as you are only liable for your personal investment in the business. It's easier to raise capital, which you can do through selling stocks or shares in the company. There are tax benefits for S corporations, as they can split income between business and shareholders. And in terms of time, since it is a separate entity, even if the owners die, the business will still stay since it's its own entity. But there are some disadvantages to it too, as it is very expensive to form and operate, and there are many regulations and protocols for corporations, as well as it's very difficult and long to actually become a corporation. And then some forms of corporations, like C corporations, actually have double taxation. Looking here, you can see that because sole proprietorships are the easiest to incorporate, they are the most common. But looking at it on a societal level, most sales revenue comes with corporations, meaning that corporations are usually at a larger scale and they are generating most of the money in our economy. Now, looking at the accounting differences for partnership and corporations, it largely is in the equity section, where let's say you had three owners, Smith, Washington, and Coles, and their total capital resulted in 180,000. This would just be added to the liability section, in this case 100,000 plus 180,000 for 280,000 in total liabilities and capital. But for corporations, instead of having capital of the owners, it has the total shareholders' equity and the liabilities. So in this case, again, the accounts payable will be 100,000, but then doing the calculations, looking at the share capital and then the retained earnings, you would add that up and get the total shareholders equity of 5.2 million, and then add this to your accounts payable of 100,000 to get 5.3 million. So the key difference between partnerships and corporations is that on the balance sheet, at least, there you have to deal with stocks and shareholders, while for partnerships is simply the partners who are partial owners of a company. And here's my reference page. Thank you.